Ramesh Gehaney, the Executive Director and CEO of Endurance Tech, joins us now to talk about that. Mr. Gehaney, good morning. And things have only escalated out of control since we spoke last. I remember you telling me that, nothing will improve until the gas prices settle down in Europe. And far from it, it's actually only gotten worse. What do you think the impact of this would be on your own business for the rest of the fiscal?
Good morning, Sonia. Good morning, Sonia. Yes, I said this last time also, and I repeat that unless or until the gas prices and energy cost doesn't, seemingly come down, the challenges in Europe are going to multiply. Now, when we are talking about Q1 of last year, when the gas prices were just about $17 a megawatt, and now it's close to 100, which is 5 times. And as we talk, July and August has gone further deepening to somewhere around 100% more over and above where we were. So this is probably one of the biggest challenges and things which Europe is facing all across. And I strongly believe that unless and until the war situation doesn't end up or something, and the gas prices don't come down, the prices and the business model will continue to be under challenge and difficult situations.
Mr. Gehaney, just a basic question. When we talk about European gas prices and electricity prices going through the roof, do businesses pay whatever we hear, the $750,000 a megawatt? I mean, or it's subsidized. By the time the businesses pay, the state steps in, subsidizes a large portion of it.
See, you'll agree one thing, that subsidies don't work in long run, and you can only ease out the situation by giving some subsidies here and there, but it doesn't work out in the long run. What I understand that now we're talking about power cuts to the extent of 6 to 8 hours a day. Now, if that happens, which is likely also, if that happens, then the pressure on the industry would be far more. Some of the industries, some of the low-ended auto ancillaries, they might even shut down because they would not have the muscle power to bear this, this challenge of electricity cost. Because beyond a point, how much can you spend from your own? So this is a challenge. The OEMs would probably be in a position to recognize this cost in coming days.
But does the state step in, sir, Mr. Gehaney? Does the state step in, or do the businesses actually pay this? I know, I mean, long term, I take your point, but what's happening on the ground now?
No, the industry doesn't get any subsidies.
So you pay whatever the tariffs are on exchanges, right? So you got to buy power at those rates.
Yes, we've got to buy power at those rates.
So just one follow-up to what you were mentioning earlier. What does a company like yours plan to do? Because so many of your peers have, taken quite drastic steps. I mean, Bazaar sold part of their European business because it was loss-making for so long. Would you at any point look to sort of cut your losses, either sell the business, or what seems to be the plan now?
See, selling the business, you asked this question to me last time. I said a clear no, and I repeat that because Endurance has worked on a very promising business model in Europe. It has complete synergies with the kind of business that we do in India also, and the kind of business we do over there. See, in spite of all these crises, if we are sitting at at EBITDA margins of 11.5, that itself demonstrates or reflects that we are in a fairly strong position, even under the present conditions also.
Mr. Gehaney, so not selling the business, you're reiterating that point. What about separating both the businesses? Since there is, Europe is going through a bit of a lull and things are expected to remain volatile out there. Global factors, global risk is at play. Will you look at separating both the businesses, demerging it?
No, certainly not. Because, see, both businesses have got their own independent, strength and business performance. The OEMs out there or the customers that we have are very strong. It's only a matter of recalibrating the whole business environment over there. I'm sure, as I speak to most of my OEMs, everybody's recalibrating itself, not for today, but probably 2 years or 3 years down the line when they don't depend on Russian, gas or electricity from anywhere outside. They're all trying to build themselves and make themselves self-reliant.
All right, Mr. Gehaney, given the challenges, given the improvements in raw material cost and this chip shortage issue, etc., what is the revenue growth number you're looking at for both the businesses? That's for the India business as well as for the Europe business. And, could give us a blended margin that we should be working with from here on.
Okay, that's a good question. Normally, I don't give forward-looking numbers, but let me give you a flavor. See, we are right now at somewhere around 39% in Q1, higher than previous year, but that is not truly comparable because we had some lockdowns during the previous period. But the numbers are moving up. And the volumes are ticking up. Some chip shortages have eased out, right? We have got all the chips or all the products that we wanted to have, and those numbers are increasing. The OEMs have got probably better allocations from the chip suppliers. So even high-end bikes and vehicles are being made. So I don't think that numbers are under any challenge right now. It's only the commodity prices which are now softening down. The earlier impacts were higher, but going forward, as the commodity prices come down, I am pretty confident that we will be able to touch the previous levels, or rather say that would be our endeavor, to touch the previous levels of somewhere around 13.5 to 13.5 or 13.6%.
Okay. Even demand in the European region is under pressure, right? We've been talking about how costs have gone up and gas prices have escalated. But look at the demand. I mean, in Q1, only 2.7 million new cars were registered. That's a 16% drop compared to what we saw last year, which was also challenging given COVID. Why do you think that is? And will that continue to be the order of the year? I mean, slowness in demand there?
Yes, that would be continuing, because right now, if there are certain supply chain partners which are not able to perform and they challenge the business model of the OEMs or the new car manufacturing, then it will be an issue. Because if you don't have the entire supply chain in a good health condition, you can't be making as many number of vehicles that you want to. But what the OEMs are concentrating on is high-end premium vehicles, in which probably they make more money, and those stocks are not there at the retail level. And that's why the waiting period of getting a new car would be as high as 15 months to 18 months.
Okay. Just a quick word on electric vehicles. I think you took in new orders of almost about 500 crores in the first quarter. And you said about 25% of that is from the EV space, where margins are higher because competition is a little limited. Could you give us an update now in Q2? What is that segment doing for you, and how much can that cushion the overall margin impact? Higher supplies to EV players.
Okay. 484 crores was the new business wins that we had in Q1, out of which 110 crores was for EV space. Now, what is moving forward for us is primarily brakes and castings. Of course, we would like to service all our product verticals to the EV players. But the numbers, and although we started a bit late on the EV space, but now we are actively involved. Our total order book, including last year, is close to somewhere around 300 crores. We are aggressively being engaged with the OEMs, and so are the OEMs coming back to us for, especially to start with, is brakes product verticals, where the orders are pretty good, and margins certainly are better, because you said that there are lesser players, but it's only a comparative basis. I'm sure once the volumes come into play, the whole pricing structure will be reworked.
All right, Mr. Gehaney, very quickly before we let you go, you don't want to sell the European business, but you've hinted in the past that you're on the prowl as well. You're looking at various acquisitions, maybe that could spruce up things on the EV side. Anything we should be looking forward to, maybe in the next couple of quarters, that Endurance Tech can close out?
Right now, I can't think of any acquisitions, although we recently made an acquisition for friction material for the aftermarket space in Europe. But it's not a good time to look into any acquisition opportunities right now. I think what is more important is to stabilize and recalibrate yourself to meet the existing business environment over there, rather than looking into new ventures.
Okay, we got the guidance on the margins you see over the next few quarters. Hopefully it goes back to the 13.5%. But I missed out the revenue growth number for this year. What was that? Consolidated revenue grows to what level?
No, I said in Q1 we are up by 39%, right? But see, revenue growth and all, we should be looking at from one angle, that if the commodity prices come down, then probably we are talking of a comparative basis, because right now the revenues may be higher, seemingly higher, because earlier quarters, the commodity prices were higher, and there was some impact of aluminium and steel onto the total final product pricing.
But double-digit growth, revenue growth at least, mid-teens.
Oh, certainly. See, I can only say one thing, that our history says that we have always performed better than the industry. And I continue to say that we will maintain that status.
Good speaking to Mr. Gehaney. Thanks so much for joining in, giving us a sense about the pain in Europe. You're optimistic on business going ahead as well. And you're not looking to sell the European business, and you don't believe it's the right time to go for inorganic growth as well. Appreciate you joining in.